Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
If you're frustrated about a company that you own shares in, write to the board, write to the chairman. You'd be surprised how much power a voice has, because if no one's saying anything and then all of a sudden the board gets a letter, they pay attention. Effectively, that's like the whole company. That's like every shareholder making that comment.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. Today I'm thrilled to be speaking with Geoff Wilson, the founder, chairman and chief investment officer of Wilson Asset Management. With over 45 years of experience in investment markets across Australia, the UK and the US, Geoff has built WAM into a powerhouse, managing over $5.8 billion for more than 130,000 retail investors through 9 listed investment companies and 2 unlisted funds. G'day, Geoff. Thanks for joining me today.
Hi, Phil. That was a bit of a mouthful, but thank you for getting it out.
I managed to get through it without stopping. So let's go back into the dim, dark past. I remember you mentioned to me once you were a Glassy, I think at the Royal Hotel in Melbourne, watching...
No, down at the George.
The George, okay.
Yeah, the George Hotel. Well, started off in the bottle shop while I was at uni.
Yeah.
And then made it to work in the bar. Yeah, that was when the George was a pretty rough place. But
but bands like Midnight Oil would play there.
Exactly.
One of those.
All of them.
Great
that's
public
right.
days. Yeah,
exactly. Yeah, that's right. And that was, well, now it's probably one of my highlights, but in those days I just had to pick up the glasses. So there was Peter Garrett going crazy with his. But yeah, no, it was
great days.
It was.
Yeah. You were at uni at that stage.
Yes.
Were you invested at that stage, or were you interested in investing at that stage?
Probably if we go back a little bit.
Yeah, sure, go back.
Get in terms of how did I get into the market, and probably go back a little further. My father was a doctor, and his father was a doctor as well. And actually, three back, he was a butcher. But anyway, I'm not sure there's any similarity there. But when my grandfather died, he owned some shares, and my father had a choice, and this is back in the 50s, if he could either get cash or take the shares. And he took the shares, and it was in a mining company. And it was when I was a teenager. I remember, Dad would work very long hours, but at night he'd sit down and he'd pick up. In Melbourne, grew up in Melbourne, so he tended to read The Age, so you got a big broadsheet. He's reading through it, and he'd stop at this page which had a whole lot of numbers on, had names and numbers.
And tiny print, wasn't it?
Tiny print. And he'd just sit there and he'd look at them. And I remember one night I said, "Hey, look, Dad, what are you actually looking at?" And he said, "Well, that's a list of all the shares that are listed on the Australian stock market." And I thought, okay, why don't I have a look? So I looked down and I thought, let me see if I can find something I can afford to buy. So I looked down and I found one trading at 1 cent. And I thought, well, yeah, I could afford that. It was a company called Cox Brothers. And then I didn't really pay much attention. And then a few months later, I think I was looking down the list and it was trading at 0.5 cent. And then a few months later, I was looking down the list and it was back to 1 cent. And I thought, geez, if I'd bought them at 0.5 cent and then gone to 1 cent, I would have made 100% of my money. And yeah, to me, that was an interesting. And then a little while later, I looked down the list and I couldn't find them. And I said, "Dad, where have they gone?" He said, "Oh, they've gone under. They've gone to."
Gee, a valuable first lesson, hey?
Well, in theory, and I learned it was a retailer, and I probably maybe since then I've always thought, hey, retailing is a hard business, and which it is a hard business. And then, because I showed a little bit of interest, then probably a year or two later, I was looking down the list, and this was probably the start of the mining boom back in the late 70s. I was at uni now, and I was looking down the list. And I was trying to find a cheap one, and it was a company called Timor Oil and Gas, and it was trading at 10 cents. And I thought to myself, if I bought $1,000 worth, and it went to 12 cents, then I make 20% on my money, a couple of $100. And so I said to Dad, hey, look, will you lend me some money to buy $1,000 worth of Timor oil and gas? So, maybe it's like going to the races and winning on the first race and thinking this is the easiest thing. I'll do this for the rest of my life. So he lent me the $1,000. I bought the shares. They went up to 12 cents. I didn't really know what they did. Obviously,
no fundamental research.
No fundamental. Yeah, just they were cheap and they had leverage. Obviously, Timor Oil and Gas. It was an oil and gas company, but that didn't that didn't feature in my assessment. I was just looking for leverage, and so I sold half at 12 cents, and then they kept going up. So I thought, I'll keep the other half, and I sold the other half, I think, at 32 cents. And so maybe you see, maybe that was the bug, but it actually wasn't necessarily the bug, because I finished uni, wasn't quite sure what I'd do after uni.
Did you do finance at uni?
No. I actually did sort of pretty much the subjects I did HSC, even though HSC in Melbourne, I failed English. So therefore, I actually failed HSC. And I went to St Kevin's. I went back to repeat at Melbourne High. I thought, different school. Now, I actually had read, I think when I did it the first time, not sure if I read any of my English books. But when I went back to repeat it, before I started, I'd read all my English books. And then actually, I was more interested in science, because I did biology, HSC and maths, and I was more interested in that side. And then I actually got into uni, because La Trobe Uni down there looked at everyone's marks excluding English. And because I actually passed excluding English, but in those days, if you failed English, you failed. So I only did my first week repeating, and then went to uni and ended up doing a science degree. And at the end of the science degree, sort of major, minors, chemistry and maths, a little bit of econometrics second year, and first year economics. It was just trying to work out, what will I do? And like everyone after uni, you got no idea.
I drove taxis after I left uni, because at that time unemployment was huge, and there was no jobs.
Oh, were you around the same time? 79, 80, around that. Yeah, well, 100%. So I was working down the pub.
Yeah, that's right.
I was working part-time.
People don't understand. I mean, I don't want to go back and say how tough we had it, because obviously young people have it really tough these days. Yeah. But it was, and I did a media course, and there were no jobs in the media. It's not like now where you could start up a YouTube channel, for example.
Yeah, but it was tough. It was really tough.
Had to drive taxis for a couple of years. Yeah.
Yeah, I'd been working at the pub while I was at uni, just to get some extra money, and then I worked full time. And actually, it's bizarre, all these sliding door moments. So I'd been working at, I looked around for jobs, I'm sure like yourself, pick up the paper every Saturday, circle all the jobs that you think you've got qualified for, send away your CVs, and get an interview if you're lucky, and not a job. And it took me like over a year to end up getting a job. And I was working down the pub, and actually while I was working down there, some of these sliding door moments, the guys that ran it, Graham Richmond and Todd Shelton, they actually ended up buying another pub. I think it was actually in Richmond. Of course, I was down at Fitzroy Street, St Kilda, and they offered me an opportunity to go and run it. Here I'm in my early 20s, a sort of single. What an incredible opportunity. I don't know why I didn't take that opportunity, because they were going to pay me, I think I was getting paid $10,000, working at the bottle shop and on the bar, and they were going to pay me $20,000 and a percentage of the profits. But for some reason I didn't take it. I assume maybe my parents asked me some questions. To me, parenting, that's where parenting, I think, is so important, because you've got to let your child think they're making the decision. And I don't know if my dad asked me a question or my mum or what it was, but for some reason, like, why didn't I take it? I didn't. Anyway, and I ended up getting a job. We won't take you through all the potential jobs I nearly got, but ended up getting a job at Scottish Amicable, and that was an insurance company, been in the investment department, and they had 3 people.
And they took you on without any educational background at all?
Without any experience.
Yeah.
Yeah,
but specific to the economics
exactly.
or finance.
I suppose the good thing, like you would have found, when you've gone for 20 or 30 interviews, and whatever degree you've done, you've found a way of explaining how it works with the interview you're going with. If you've done a media degree and you've gone for a management role, then you've got to somehow, well, the great thing about media is...
It's training you for this particular
Exactly, that's right.
Mm-hmm.
So... obviously I did first year economics, second year econometrics. I focused on that. Focused on the fact that my mother and father had bought us all some shares. I'm one of 6, so all the kids had a couple of shares each. So I could talk to the shares that I already owned, trying to explain that I knew what was going on.
You could read that tiny print in the Age with a list of the prices.
Well, but then the funny thing is, so I got the job. I was sort of as a trainee analyst. My boss sort of sat me down and said, look, for the first couple of days, can you just read these research reports on companies just to get yourself up to speed in terms of the companies we've invested in and what we're doing? And after the second day, he sat me down and said, look, I just want to understand exactly what you know in terms of investing. He said, do you know what a PE is? A price earnings ratio. I said, no. He said, oh, okay. He said, do you know what EPS is, or earnings per share? And I said, no. So he said, okay. So he realised I knew nothing.
Because they're the very basics, aren't they?
Very, very basics. So to me that was, he realised that, and that was a journey of understanding and learning about the stock market and how to invest in it. And that was as you said in the intro, that was 45 years ago.
And it's just great that you were able then to get that training, but on the job at the same time as well, isn't it?
100%.
Yeah. Rather than being theoretically in a lecture hall learning all of this.
Yes.
I mean, you can get the hands-on experience there. While as you're learning,
and you learn very quickly. And what are some of the early lessons? And I know back in those days it was a bit more laissez-faire in terms of how things were operated. Compliance wasn't that big, etc. So I was working for a fund manager, and you were allowed to buy shares. And obviously you couldn't buy shares that we were buying. And I remember one of my first lessons was, there was a company, a gold mining company, that seemed really interesting. And I thought, I'll buy some shares in it. So I said, of course, I have no money. I said to Dad, hey, can you lend me some money to buy these shares? And I wanted to buy them because I had a view on the company, and I had a view, obviously, on the gold price.
With a little bit more expertise under your belt, presumably.
A little bit, not much, just a little bit. Some of the early days of expertise. And then... So I made the decision to buy them. So then I thought, okay, I'm going to sit on the market and I'm going to buy them at this price. Well, that was my error. And I never bought them. And actually, the thesis was correct. The gold price did go up and they did perform well, but I own no shares. So one of my very early lessons was, if you decide to buy a company or buy shares in a company, to become a part owner of that company, then buy them. So you can try to nickel and dime a little bit, but maybe the secret is buy some, so at least you have some. If you spend all the time and the effort and the work to decide it makes sense buying, and then if you want to sit back and try to buy the others a bit more cheaply, then do that.
Are you confused about how to invest? Life Sherpa can ease the burden of having to decide for yourself. Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
Because that's what one of the theses is behind value investing, that you're waiting to buy a good company at the right price. But you think, because you see there's great companies on the ASX all the time, and they never come under a value metric, I would suggest.
Well, I'm more sort of, to me, that's sort of a bigger question. I'm more like, if the company's trading at $1 and you want to buy it because you think it's going to go to $1.50 or $2 for some reason, then you're like, don't sit there at 99 cents and hope it'll come to you.
Right. Yeah.
To me, it's more if you've done all the work, and as you said at the very start, if you just want to get a dart and throw it at companies and we'll buy that. That's one way of investing. But another way of investing is and how we like to invest is do some research and have a thesis of why you're buying the company. And then if you've done all the work and believe that's the case, then I should have paid 101 and bought the shares rather than tried to buy them cheaply. If I've got a lot of money in the market, if I'm committing additional money to the market over time, then of course you can be a bit more selective in terms of trying to nickel and dime on the price. But that was sort of an early lesson. Yeah.
So within a few short years, you were working on Wall Street.
Well, I wouldn't say a few short years. One of the interesting things is in the first, so my first time as a fund manager, my first couple of years, and then I went from fund manager to stockbroking because back in those days, like I was in my mid-20s now, and this is back in the early 80s. And funds management was sort of a newish, evolving thing. Having money managed on your behalf, like that was a new thing as well. And the interesting thing is the people in fund management tended to be quite, well, we used to say back then they sort of had a personality bypass where all the, I'm in my early mid-20s, all the interesting thing was, all the excitement was on the stockbroking side. And anyway, I ended up going from there to be an analyst, analysing companies for a stockbroker, and then eventually went to London for a few years, and then back in the latter part of the 80s, which I was working in New York, and not actually on Wall Street. We were sort of midtown. That's where the office was, but I was there during an incredible time. It was the 86,
the crash.
86, 87, and early 88. Where the market fell. I think it was 25% on that day. It was the 19th of October, 1987, and ended up in Australia. It fell about that percentage that day, but it kept falling for another probably 3 or 4 months, where the Australian market fell, I think, from top to bottom close to 60%, where the US market didn't fall anywhere near as much as that. And the interesting thing is the US market was back at an all-time high 2 years later, even after the 87 crash. And that was brutal. Like there was people they're committing suicide. I think there was a broker. People lost a lot of money. There was a couple of brokers, their clients had lost a lot of money. They geared in. They didn't understand the risks they were taking in the equities. And I think a few brokers, they came in and shot the brokers. Like it was a challenging period to observe what was happening.
Oh God, yeah.
But the great thing about what I've learned, and probably from an investing perspective, probably in the early days, I was a big one on timing of the market, and broadly, I think you can time the market, meaning when everyone tells you the market's going to go up forever, then you're probably better off of having selling a few things and holding a bit of cash. And when everyone says, look, this is a disaster and the market's never going to recover, then that's when you want to be, that cash you've got, you want to be investing. You want to be investing it. And what I've pretty much learned over that time is, even though you try to do that, it's hard to do. And there was a great book that I read a year or so ago that looked at the last 20 years. It was looking at the US market and said, okay, if you invested in the US market 20 years ago and held your position for 20 years, then you've made, I think it was about a little over 8%.
Per annum.
Per annum, over that 20-year period. If you missed just the one best day in the market, that's 20 each year, so that's 20 days. That's all you weren't in the market for 20 days, your return was close to zero, virtually nothing. So, yeah, we talk about trying to time the market. I think it's what I've learned. It's time in the market, which is important.
Do you think crashes are what they used to be? Because crashes seem to be not as protracted as they used to be in the past. And I know with the...
No. It's interesting. It's interesting you ask me that question because it's casting my mind back. It reminds me back in the early 80s.
And then the GFC, of course, which was
that's right,
very protracted.
But when I started in the industry, learning about economic cycles and obviously a little bit at uni, but how important they are in terms of driving economic growth, driving valuations, etc. Back in the 80s, everyone was saying, "Oh, economic cycles are shorter now," and to me, we still have greed. And we still have fear. And so we still have... greed obviously creates the extremes because everyone thinks, the market will go up forever. They don't realise that that it is cyclical because it gets pushed up by everyone's confidence, and then it gets pushed down by when everyone
gets fearful.
Fearful. There
just seems to be more of an evening out. Well, of markets.
more recently.
More recently, yes.
I wouldn't say that's forever. It's more what happened and what we saw back in the GFC, the global financial crisis, back in it was 2008, 7, 8, 9, around that period, is what was learned, and this is when you talk to people that were working at the US Federal Reserve at that point in time, and they tell you that there was a weekend where they thought that they was looking over the abyss in terms of what would happen to the economy. It would grind to a halt. When the various big companies had gone under.
The big banks, you mean?
Drexel's, big insurer, AIG, looked as though it was going to go under. So that the wheels of commerce were going to grind to a halt. That's what they were looking at. And what they realised is to push liquidity into the system. And they did that over a year and a half. And that sort of got the patient who was nearly dead, got the patient standing up and running around again.
Like a transfusion.
Exactly, that's right, a big transfusion. And then what they learned, because they learned that's what they needed to do. So then when we had the COVID situation, the same amount of whatever they were transfusing in, meaning money, to liquefy the system, that was done, instead of over a year and a half period, it was done over a 1 month period. The amount of liquidity that was pumped into the system. And I know, the Federal Reserve, when COVID started, they went around the world to keep the world liquid and offering everyone lines of credit. And they offered Australia $50 billion worth of credit. They just needed to keep the system going. So it sort of brings us into to inflation. And it sort of, I'm not sure if we want to go there, but it sort of brings us into asset price inflation and inequality, and also, debasing of currencies, and sort of where crypto, and Bitcoin, sort of.
The long-term negative effects of pumping liquidity into the system does create inflation. I mean,
correct.
And the inequality. I mean, I've been having these discussions with some of my socialist friends about this,
Oh, 100%.
And people think that it's, we're just going to tax the rich. I don't want to go into that too much.
No.
But that the idea is you tax the rich and redistribute it.
Yes.
Whereas there just doesn't seem to be enough publicity given to the argument that there is money gets pumped into the system. It creates inflation. People who've got money already, their asset prices go up and people are left behind.
That's exactly right. The thing is, you can't tax your way to prosperity. You actually need, and probably we don't need to go there, but the whole tax system in Australia needs a big shake-up.
It's rooted.
It needs to encourage people working. It needs to encourage people to invest. It needs to encourage people to start up businesses. Now, I know we won't get there now, but one thing that I'm very disappointed about the government at the moment, and which is bad policy, illogical, is they're talking about taxing unrealised gains, which has a very negative impact on the economy, on risk capital, etc., etc. But let's...
Yeah, that's a whole other podcast episode,
that's right,
isn't it?
That's right, yes. So back on investing.
Back on investing. No, it's just interesting to talk about that. But I just wanted to get back to listed investment companies.
Yes.
Or our mutual friend Ian Irvine from the association now calls them friend of the podcast. LIVs, he calls them now.
Well, I'm still, you're either an LIC, listed investment company, or an LIT, listed investment trust. But I know, LIV is a vehicle.
That's right, the vehicle.
Yeah.
Just briefly run us through the difference between an ETF and an LIC.
Yeah. Well, an ETF is an exchange traded fund, and it uses a trust structure. So when you buy shares in an ETF, you get in at the value of all those underlying shares. And when you sell them, you sell at that value. It's a trust structure, so it distributes all its income each year. And, there's no board or, there's a company that runs it. So if you want exposure to the stock market, then to me, an ETF is a great way of doing it. If you don't want to do any research, you just think, I want exposure to the broad market, or you might have an area of the market you want to be exposed to, then ETF gives you that opportunity. Then I call, Ian's listed investment vehicles, or most of them are listed investment companies, so I'll
stick with that, whatever you want. Yeah.
LICs I call them, they are the thinking person's ETF. So what is the structure? It's a company structure. So the shares trade on the stock market and you buy shares off someone else. So those shares can trade, and the value of their assets is called NTA, and those shares should be worth, they are worth the NTA. The thing is, they don't trade at that all the time because the stock market's supply and demand. So a whole lot of people might think that fund manager's doing a great job and love him and pay above what the value of the assets were or are. I mean, we had one of our funds, which is them trading above what they're worth is as ridiculous as them trading below what they're worth. But one of our funds 3 years ago traded at 58% above what they're worth. So you're effectively buying $1 of value in the fund and you're paying $1.58. Let me give you a word of advice. Try not to pay a premium to what they're worth. And then how I get caught there is then my sister asked me, she said, well, we've got 9 of them, as you said. One of ours looks at small companies, WAM microcap. And my sister said, look, I want to buy some shares for her daughters, which are mid-teens, and I want to take a 20-year view. And I said, well, you probably want risk and reward, and so you probably want microcaps. And she said, well, but that's trading a 6% premium, and you've told me never pay a premium. And I said, well, 6% over 20 years is per annum is only 0.3% premium per annum. So all they have to do is outperform by 0.3. So, I mean, broadly, it's a broad thing in terms of not paying premium. Try to buy them at NTA or a discount.
And these tables are published.
Exactly.
Easily defined. Easy to find what the NTA, I think monthly
NTA. So, so the good thing about the LIC is, one is like an ETF, whatever that's made there gets paid out because it's a trust structure. The LIC is a company structure, so it's a closed-end pool of capital. And the reason why, like the bulk of our business are LICs is, go back, I started the business 27 years ago, probably 30 to 35 years ago. I read a number of research reports that talked about a closed-end pool of capital in a company outperforms an open-ended pool of capital in a trust. So two things came to my mind. One is it's a superior vehicle because the money that's in that company stays in that company. So you can take a 1, 2, 5, 10-year view as an investor. That's as the fund manager managing that pool of capital. You're never forced to buy at the top of the market and you're never forced to sell at the bottom of the market, where a trust structure, money comes in and at the top of the market and flows out of the bottom of the market. So to me, it's a superior structure. And another thing is, in terms of it can make money and it can pay you those dividends over time. So it's great for people that want dividends, consistent dividends over time, where a trust, you might have a great year one year, then you have a terrible year the next year. And also another thing that I think is good is there are boards of these companies. So they're boards and they're listed on the stock market. So you can hold the board to account. I know there's only the annual AGM, but it's surprising, and anyone listening to this, effectively that's like the whole company. That's like every shareholder making that comment. So to me, the accountability is good. They trade on the stock market and you can buy and sell them. And in theory, some of them trade at discounts, and then you do your research and you've got to work. That's why you've got to do a bit more work. Understand, why is it a discount? Is it going to stay at a discount forever? Is it a discount because they're performing badly, the fund manager? Or is it just a discount because there seems to be a lot more selling than buying, and the company, the board's doing things to get it to trade at NTA? So you can do a little bit more. You're getting exposure to the market, you're getting active management, and you're getting, potentially, if you're buying at a discount, the benefit of it getting to NTA. So that's why I like it. And then the next step is if you want to do a lot more research and pick individual companies. And that's probably in the very early days, I realised that when you bought a share in a company, that you become a part owner of that business. And that's how you've got to think about it.
It's so basic but so important, isn't it? It's not a horse on a racetrack.
No.
It's a living, breathing company.
Yes.
That you can end up having this whole company working on your behalf.
100%. So I remember one of the early companies I bought, when I was working, was I bought shares in Coles because they had a discount card. They don't have it anymore.
They don't do that anymore, do they? They used to be great with some of these companies. You could get shareholder discounts.
I don't know why they don't. Because A, there was a discount card where I got 2.5% discount. And then B, I knew that every dollar I spent in there, I was getting a fraction of it back. Now, I was only getting a fraction, but I was getting something back. Anyways, to me, that was my naive way of doing some early research. Yeah.
Can we go back 27 years?
Yes.
What was it like starting your own company? Was it hard? Was it scary? And tell us about that in your first LICs.
Yeah, well, it is. And my very first exposure, or when I started working, I was working as a fund manager for a couple of years, and then the next 18 odd years was on the broking side as an analyst for a period of time, and then institutional sales and probably corporate. So that was that got me to a certain level. And then the tough thing about stockbroking is I was 40. I had a daughter who was then 4 years of age, and a wife. And stockbroking is very competitive. So it's competitive internally and externally.
And of course, with online broking coming in as well, it would have made
online broking wasn't that big. I was institutional sales. So it was really, working as hard as you could to get the information to the big fund managers, the big institutions, that then they would buy and sell shares through you. So it was, we'd have a morning meeting where we'd talk about research ideas and with our research department. And, in the early days it was at 8:30, then it became 8 o'clock, then it was 7:30, then it was 7 o'clock. Because we wanted to be the best. So you wanted to be the first, with the information to the fund managers. And I thought, like, pretty much it was, to describe it, it's like the fur-lined mousetrap, where you're making a lot of money, but it's killing you. And I just sort of it was just strange that I've got this beautiful daughter and my wife, and I can't have breakfast with them each morning. Mm. And I sort of went through, like, there must be a better way of balancing your life. And around that time, there was a book that came out called The Empty Raincoat. I think that's what it was called. And it talked about how life's going to change. I'm not sure if it ever has, but how we'll have a portfolio of jobs. And I was trying to work out how to get balance in my life at the same time. And then around that time, one of my corporate clients, Tim Hughes from RG, he managed Reg Grundy's money, said to me, look, what do you really want to do? I think we're at lunch. And I said, look, I'd actually love to like have a little funds management business, maybe write a book, maybe go on a couple of boards, thinking of that portfolio approach. And of course, so I could spend time, I could have breakfast with my family. And he said, well, I'll give you $10 million to manage.
Just like that.
yeah. And then it was a bit like that, because then that was at lunch. Then I think a month or two later, I said, Tim, could we have lunch again?
haven't seen the 10 million yet.
No, I didn't have lunch. No, I was still working as a broker. I didn't have lunch. I said, can we have a coffee? And then I said, is that a real possibility? Because I've been giving it a bit of thought. And he said, yeah. And then the funny thing is, we 97, the latter part of 97, and I resigned from stockbroking and set up Wilson Asset Management. And the logic, why did I call it Wilson Asset Management? Because it was going to be my own little pool of capital, my money, putting it with other people's money, so then I'd be seen as an institution, but it would only be a small pool of capital. And I thought, hey, look, I'm never going to sell it, so I'll just call it after myself. But also, I thought I'd go on a couple of boards, which I did, and then also write a book, which I started writing, which I ended up writing. It's called Master of the Market. We did 2 editions, but it's a fascinating read, but it's very old now. It was interviewing fund managers. And so then, the 1st of January, we're getting up to the 1st of January 98, so that's the day I'm starting. I said to Tim, hey, look, ready to go, 1st of Jan. He said, how much are you putting in? And all I had in the world, I had a house, but all I had in the world was $500,000. And I said, look, I'm going to put everything I've got in, $500,000. He said, okay, I'll put in $500,000 as well. So we started with $1 million. Mm. Eventually, he put more money in. But yeah, that's where we started, with $1 million. And in theory, it was in a trust structure. We've still got the trust. It still works. I think it's done about 16% per annum for 27 years.
So it's a listed investment trust?
No, it's an unlisted trust.
Unlisted trust,
yeah,
okay.
Just an unlisted trust structure. Mm-hmm. And then what we did is we did our first listed investment company, which is WAM Capital, and that was a mirror of the trust. In theory, it was obviously strong research background. So I had a methodology of investing, which we've all. Anyone who's listening to this, everyone has a methodology of investing. They just mightn't have written it down. You might be a counter-cyclical investor. You might want to buy when everyone's negative. You might be a momentum investor. You might be a growth investor. You're looking for growth companies. Everyone's got a different way. And the good thing because when I started, I had to work out what type of investor am I. And when I was managing my own money, I was a counter-cyclical, high-risk investor. So I'd take big positions in companies that were beaten up. But then what I realised, managing my money along with other people's money, if I can make 1 or 2% per month, then at the end of the year, I've made 12 to 24%. Mm. And talking to some of the really good fund managers around that time, I remember Greg Perry was at the top of his game. I remember Greg saying, look, it's really about not making mistakes, not losing money. Is incredibly important. So probably in the first 6 months, I really spent a lot of time crafting what my investment process was. That was drawn on a lot of experience, over a couple of decades. And I end up putting it into a methodology because the asset consultants want to come and see you. They never gave me any money, but they came and see you. It's sort of the rating system we use. Well, first of all, what I've learned is there's the greatest correlation between a share price and anything. Some people say it's free cash flow. Some people say it's return on equity. Some the various things. But what I've seen over a long period of time is the greatest correlation between a share price and anything is earnings per share growth. So that's right. The growth in the profit on a per share basis.
Ditch the spreadsheets. ShareSite is Investopedia's top tracker for DIY investors. Invest smarter, not harder. Grab 4 months free on an annual premium plan at sharesite.com/shares for beginners. And this is quite high up in the accounts, isn't it? The earnings per share.
Well, exactly. Effectively, it's the net profit divided by the number of shares on issue is the earnings per share.
Mm.
So that's the earnings per share, and in theory, it's say the company's earning 10 cents a share. Well, it's actually just the profit growth, assuming there's not dilution from additional shares being issued. The profit growth of the company, the share price should reflect the profit growth of the company.
Mm.
If the profit's declining, then the share price should decline. If the profit grows, then the share price should grow. So it's that's the greatest correlation that I've seen over my period of investing. Also, what's incredibly important is management. So like when people give us money to manage, they are trusting that we will manage the money well on their behalf. When you buy shares in a company, you are trusting that the CEO will do a great job managing that company on your behalf. So it's management, earnings per share growth or profit growth, and then we've got a valuation matrix, or a valuation method, and that's, we come back to the things I learnt at the very start on the first day, on the third day that I started in the industry. It's the PE, the price you're paying for those earnings. It's the price to earnings ratio. That's the third one, and the fourth one is the industry they operate in and how they're positioned in that industry. And that's why, like some of the great books you can read, one of my favourites is the Peter Lynch book, from Fidelity years ago, called One Up on Wall Street. But he wrote a great second book. It was called Beating the Street. And that's where he went to high schools and talked to the kids there and realised that they could see the trends that are occurring. And if you followed, what they were telling you what was going to happen, you do better than the professionals on Wall Street. So to me, as an investor, it's very important to observe, be curious, listen, read, see what's happening in the world. Because when you're buying, and again, it comes back to that fundamental reason of when you buy shares in a company, you're part owner of that business. So you've got to look at that business as if you're the CEO, or you nearly look at the business if you own 100% of the business. Do you think they're doing a good job? Do you think they'll continue to grow? Do you think they'll continue to do a good job and grow, et cetera, et cetera? In terms of just finishing off our rating system, so I broadly gave you the outline of what we look at, and then I'll give it to you in numbers. So effectively, we rate management, that's first, and we rate that out of 10. So, okay, say I'll rate you. This is your business.
Yeah, that's right. Does the waveform on the screen look okay? I'm not distorting.
That's
or
right.
anything.
No, very professional. Like it's all set up here.
In my professional slippers.
Exactly. When I came in here, you gave me a cup of tea. I had coffee or tea, coffee machine. So it's all very. So, my experience so far is I would rate you highly. But say I'd rate you out of 10, but I'm a taskmaster. I actually don't know how this works as a business, so I can't assess that. So maybe I'll rate you 7 out of 10. But then to get it, the weird thing is, and then we multiply it by 2 to get it out of 20. Now, why do we do that? Because if you rated someone out of 20, you would have rated them differently. So 7 out of 10 multiplied by 2, so you're 14 out of 20. So you got 14. Then I look at then the next one is the earnings per share growth. Now, the problem is I don't know how much you earn.
And you don't know how many shares I have in my company.
Well, yeah.
Which is all owned by me.
Yeah, well, but I don't know what growth.
Yeah.
Yeah, but let's say, it's an operating.
But I could give you an output of my accounts, for example.
Well, no, but okay, but would your growth from last year to this year? Have you had growth?
No, I haven't actually. No, it's been a bit backwards this year. Okay. Just as an example. Yeah.
So therefore, let's say minus 5%.
Mm-hmm.
Unfortunately, we won't buy shares in you. No, because they're
not for sale anyway.
But because broadly, to rate on our system, you've got to rate 50 or above.
Yep.
So what it means is, say you get the good management or whatever it is. Say you've got 14. How you get the other rating is by earnings per share growth, valuation, and position in the industry. And let me finish off on those. So you can look at what the earnings per share growth of a company, and you look at it over the next 2 years. Say it's growing at, let's just say 10% this year, and say 12% next year. So on average, it's 11%. So that's 11. So we've got 14 and 11. And then what we do, and this is where it gets a bit trickier, is we divide by the earnings growth by the PE. And so you've got to be listed on the stock market. Say you're on a PE of, the average market PE, what's it?
18 or something?
Yeah, say 17? It's 18. Say, let's say...
Maybe with the Commonwealth Bank at the moment, it's pushing it up.
Yeah, let's say 15. We want a cheaper company anyway. Ideally, you're trying to buy the lowest PE and the highest growth. But let's say 15. So then it's 11 over 15, which is, what's that, 0.75 or something like that, or 0.7? Yeah.
A bit higher than 0.8?
Yeah, 0.8. Yeah. But then you multiply by 10.
Mm-hmm.
So it's 8. So what do we got? We've got 14, we've got 11, and we've got 8. And then the last one is the industry you're operating in and how you're positioned in the industry. And say if it's this. Well, so there's the podcast industry, is it?
Mm-hmm.
Highly competitive. I'm not sure how you're positioned in it. So to me, that would be it's a tough industry. So I'd probably and your position in it, you probably position well, but it's a tough industry. So I'm probably only giving 6 out of 10 there. So you add them all up, and if they're above 50, then it's a buy. If below 50, it's not.
Is it that simple, the process?
For us, yeah, because what you're basically doing is buying a well-managed company, this is for us, that is trading on a low PE, that has high growth, and is well-positioned in a good industry. That's sort of the summary of it. It's that simple. Then it rates a buy. We don't buy it. We don't buy it unless we can see a catalyst that's going to change the valuation. Because say you've got, we rated your business and say it was a buy, say you had earnings growth, then what's going to change the valuation? If the market looks at your business, what's going to change the market from deciding your business is worth whatever it's currently worth? What normally changes that is there's an earnings per share, like there's a profit. You exceed expectations in terms of what everyone was expecting you to make in terms of profit. A profit surprise, or there's a structural change in an industry, or you might take over another podcast business. Oh, that's going to be good. Or we might realise that podcasts are just going to grow at 100% per annum forever. So to me, structural change in industry, earnings surprise, positive earnings surprise. Now you need a catalyst that's going to change the way the market looks at that company.
Is
Yeah, that's how we do it. So, yeah.
And it's the same methodology whether you're looking at the big end of the market or micro caps?
Yeah. The micro cap's a lot easier. The big end of the market, it's a lot harder because, less companies rate on that rating system because they're not usually growing. Because effectively a company's got to be growing at 1.5 to 2 times its PE to rate on our system. And so, therefore, the larger companies and the guys that run WAM leaders, they can do that, but they have to look at other, they spend probably a lot more time looking at global metrics or dynamics and and sort of flow of funds, like what's happening globally and how will that impact the large companies. Yeah, so to me, we use this extensively in the mid and small cap area. It's just a little harder in the top 100 to do it because you don't get companies, effectively no one rates.
And all of these key points, are they dynamic, and how often can they change?
Oh, yeah, dynamic all the time. Yeah, dynamic, because you've got to be 100%. Well, effectively, management doesn't necessarily change that much because they could leave and a new person could come in, or usually good managers are good managers and they stay good managers. And bad managers are bad managers, they stay bad managers. But in terms of, like earning surprises, like something could happen, or, the tariffs are announced. Oh, so therefore, like I'd expected that company's earnings are going to grow like that. Now they're not. Or the tariffs are going to be positive for that company. Or like to me, it's dynamic. So you're taking in all the information and you're assessing the earnings potential of the company. Or what you anticipate the earnings will be.
How is the mentoring process for the analysts that you employ managing these funds? How does that operate? How do you instill this view with your teams?
Oh, well, that's sort of the process that we've always used, and everyone knows that's the process we use. In terms of...
are there any people that have to unlearn bad habits, for example? Or is it pretty easy to slot into?
I think everyone's got to unlearn bad habits.
It's always a good thing to do, especially in investing, because there are so many of them.
And one of the things we've got is, this is just accept your mistakes. That's a big philosophical thing that we've got at our place. Like when you make a mistake, apologise to everyone else. We always make mistakes. The incredible thing is, I remember seeing a study, it was in one of the papers about, just showing over time how this fund manager had outperformed by, I think, a couple of % per annum. But he said that he had outperformed by a couple of % per annum, but 40% of his investments he lost money on. And this is a number of years back. I remember reading that and thinking, wow, I wonder how we've gone. And so, since we've been operating, I think, we've outperformed by 5 or 6% per annum. So really, really good outperformance. And you'd think, well, you've obviously got most of your calls right. Back, this is probably 6-7 years ago when we did it, 60% of our investments we lost money on and 40% we made money on. And this probably comes back to another thing you learn is when you make a mistake, you got to admit it and cut your losses. And we found with our profitable investment decisions, we ended up making a multiple on our money. 100% or 200%. So in theory, if you are want to manage your own money, then you've got to spend the time and the effort and pay attention. And
which is, before we started, that's what I say. I would just want to make the point in this podcast that people get this idea that they can suddenly become a stock picker because they've heard about a company. Yeah. They're the only person in the world that's heard about it.
Yeah. I mean one of the
but there's so much work, isn't it?
There is
a methodology.
Yes. I mean, one of the good things is the odds are you'll do reasonably well because the market goes up over time. The thing is, what you've got to do is also work against your emotions. That's what the good investors are. Work against your emotions, because when you're scared, like the weird thing is, from my perspective, is when the market's falling, when there's real carnage on Wall Street, I sort of wake up in the middle of the night and watch it for an hour because I'm excited. Now, was I always like that? I think that's a sort of a more learnt response, because you know that when everyone is scared, then the opportunities are going to present themselves. Yeah. We saw that recently with the
tariff crash.
Yeah, the tariff crash, or the Trump tariff tantrum, or with the market. We do a 12-month roadshow to major capital cities, and we actually did it over that 2-week period. So everyone was very nervous, and the big message was, it's timing the market rather than timing of the market, and taking them through that in a year's time the market will be higher. So even though it feels painful at the moment and you don't want to invest, now's the time you should be investing. But it's hard to do when it's happening. Yeah,
and is there a methodology for managing when you do get something wrong?
I just got to sell.
But how do you? What is it that?
What's wrong? To me,
what are the reasons for selling? For example,
for us is there's multifactorial. One is the catalyst occurs. Like effectively, we're trying to buy an undervalued growth company, and buy it when a catalyst we think we can see a catalyst is going to change the valuation. So if that occurs, like if they come out, if we think, geez, this company should be doing really well, and if it comes out with an earnings surprise, a positive earnings surprise, and we don't think there's going to be another positive earnings surprise, then we'll sell. Like if there's any negative things, like to me, is that you've got to assess, say if something happens, say the tariffs, say if that's announced, well, I mean, the thing is, from our perspective is, everyone knew tariffs were coming. They didn't know how they were going to come, but they all knew they were coming.
I think a lot of people were in denial.
Well, no, it was just how he did it. I think that was the crazy part. So pretty much all our investment guys, they had set their portfolios so they didn't have companies that would be negatively impacted by the tariffs. The fact is, how he delivered the tariffs was horrendous and created all the uncertainty, and he thought it was the big sort of show day. Ended up being a disaster, and he had to backtrack, and effectively the stock market smacked Trump over the head, and he had to reverse everything he had decided he was going to deliver on that day, or most of it. So, and like if you're expecting a company to do something and it doesn't do it, to me that's the thing. That's probably the big negative in terms of, I say, hey, I invested in Coles. I thought I thought retail sales, I know they're tough, but I thought they're doing well. All of a sudden their result comes out, whoops, they're not doing well at all. Well, to me, the tough thing is we're closer to the market. If you're a retail investor, you've got to take more of a medium-term view. We're trying to maximise every opportunity, so it's a bit different for us.
How important are retail investors to you?
For us, that's our business. Like the 130,000 shareholders are our retail investors. So, like when I set the business up, the whole idea was to make a difference, and that was to make a difference for myself in terms of the money that I had in the fund, and anyone else who put the money in the fund. When we floated WAM Capital and then we grew other listed investment companies, then all of a sudden we got a lot of retail investors, and now 130,000 plus. And for us, it's important to make a difference in terms of investing, also make a difference in terms of standing up for what we believe is right and standing up on their behalf. And we did that back in 2018, 2019 when, very publicly, when Labor was definitely going to win the election back then. They were odds-on favourite, and they sort of lost the unlosable election. And one of those reasons was because they had a really illogical policy on franking, where you could have 4 people that had the same amount of money and were all retired and all got different fully franked dividend results. So we stood up against that, and at the moment we're standing up against taxing unrealised gains. So to me for us it's important to make a difference and to give back. Like we We've created a couple of listed investment companies, future generation entities, where we've got all the managers to manage the money pro bono for free, which allows us to give 1% of the assets to children at risk and youth mental health, which is, is really, to me, from my perspective, it's great. We're seeing the financial industry give back, and since we've been operating them over the last 10 years, about $87 million has gone to children at risk and youth mental health. And you're getting exposure to the best fund managers. And it's actually a cracking deal for investors because they're getting exposure to the best fund managers, and normally you'd pay more than 1% for them to manage your money because they've all got performance fees. So the investor's actually getting a slightly better deal than investing with those managers. Yeah, so they're great structures.
Fantastic. Geoff Wilson, thank you very much for coming and joining me today.
No, thank you, Phil. Thanks for your time.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.